Welcome back to our intermediate financial accounting class. Over the last few segments, we've been wrapping up our discussion of the financial statements. We started out with our intermediate part 1 class doing the balance sheet. We spent a lot of time talking about the income statement and ways to change revenues and cost of goods sold and different changes in our operating expenses, as well as wrapping up the income statement with deferred taxes and EPS. Then, as we wrapped up our discussion of the income statement, we started our discussion of the last two financial statements, which were the statement of retained earnings, which we talked about in our very last set of discussions. And now we're moving on to the statement of cash flows. And that's where we're headed over this last piece of our intermediate course. And we're going to break our discussion down into two basic pieces. We're going to talk about the indirect method, which we've looked at in the past as we talked about early versions of the statement of cash flows. And then we'll talk about the direct method of the statement of cash flows, which isn't as commonly used, but is still allowed by FASB and still ends up on the CPA exam and is still used by a few companies, especially smaller companies. As always, we want to start out our discussion with why we should care about cash. Now, before we get into that though, did you notice my cool effect of this ripple? Remember, way back in intermediate financial accounting part 1, we did an example using green water to help us understand cash flows and how when the value of an asset goes up, cash goes down because chances are we paid to buy that asset. And when an asset goes down in value, then cash goes back up. That gives us that teeter-totter effect because as we sell off that asset or don't replenish the asset, then we have more cash in our bank. So I had to make sure when we were starting cash flows that I had something to help us remember that discussion in that example. So I have these cool pictures in our background and I have the cool ripple effect to transition between slides. Okay, you probably don't really care, but I was really excited to find it and make sure that I could get it working. You've probably all heard the phrase cash is king. And when I first started learning accounting, I really got upset by that phrase. Cash is not king. Accruals are king. That's what drives accounting and the records that are used by finance people, decision makers, investors, regulators, etc. It's all accrual accounting, not cash. It made me so angry that we continue to have this focus on cash. Over time, I've come to realize that they're right. Cash really is king. It is all ultimately about getting cash in and using that cash wisely to grow the business, giving it back to investors, paying off debt, growing the business by buying assets or expanding our inventory. It really is all about cash. And there are a couple of accounting reasons that it's all about cash as well. First and foremost, accounting accrual numbers have a reputation for being easy to manipulate. And it's because of some of the reasons we were talking about in our last discussion. You have to choose a lot of estimates. We've got to choose methods. And if we strategically choose estimates or methods, we can change what our earnings numbers show. So despite the research that shows that the best predictor of future performance is earnings per share and net income, cash is harder to manipulate because there's a set amount of cash in the bank. If you're going to change cash, you have to make a real decision, not just play around with your accounting numbers. And because of that, a lot of investors will use cash flow from operations, which is the cash equivalent of net income, as a check figure with net income. So they'll compare those two numbers. And they're not looking for the numbers to be the same. They're looking for them to be consistent. So if net income is positive, then we're looking for a positive cash flow from operations. If net income is negative, we're looking for a negative cash flow from operations. So the two are the same sign at least, and hopefully moving in the same direction from period to period. What we really don't want to see is a positive net income and a negative cash flows. That's one of the indications of fraud because it suggests that in reality, I have no cash to back up these accrual numbers. So the accrual numbers look good, but because they look really good when cash is really not, chances are I played around with some kind of accrual or estimate or method or other accounting gimmick to make sure that my net income stayed positive. Doesn't mean there's fraud. Doesn't even mean there's earnings management, but it is a warning sign. We also look for the other sign where net income is negative and cash flow is positive, but I don't mind that nearly as much. It's harder to do that. That's more likely an indication that FASB changed a rule. I've had to change a method. It's dropped my net income because I've had to make a bunch of adjustments because of this change in principle. or because of estimates my auditor has made me implement, and it's dropped net income even though the business itself is doing just fine. So I look for a positive cash flow from operations and net income as an indication that this is a temporary one-off situation. I look for the other net income positive, cash flow from operations negative, as an indication that maybe there's some earnings management or fraud going on here. So I really do use cash flow quite a bit as a way of controlling or analyzing net income. In addition, cash flows are used extensively by senior management for their decision making. In fact, they're used more frequently than net income numbers because cash is such an important part of keeping the business running. I had the opportunity to do some training for CPAs. It's called Continuing Professional Education. You'll all do it as you become CPAs. And as a professor, I got to go and be one of the presenters at some of these meetings. And I was doing a budgeting session, and I was working with mid-level management. All CPAs, all CMAs, so certified managerial accountants, but at kind of that medium level. And when I asked them what's more important, net income or cash, they all believed that accruals were more important. When I got to the other group, the second group that I worked with, these were now senior managers. So now we're talking about CFOs and controllers as opposed to assistant controllers and regional plant directors, etc. And when I asked them the exact same question, that senior group all said that the cash information was far more important. Why? Because that's the decision and the budgeting and the issues that they're dealing with dealt with real cash numbers, not the reporting issues as much. Now, I don't know the reason for the difference because I was training them. I wasn't just interviewing them and getting background. So I'm not sure if it's their training. I'm not sure if it's the perspective that comes with additional years of experience. I'm not sure if it's the type of budgeting decisions they were having to make. But whatever the reason, once they reached that higher level, then cash really did become king for them so that they could make sure that their business could continue functioning effectively. And as much as I hate to admit it, that's become a really important piece of my understanding of business decision making, because as much as I love accruals and GAAP accounting, and as much as I understand that it's a great predictor of what comes, when it comes down to day-to-day decision making, I have to admit as well that cash is king. And it's become such an important concept for me in changing my thinking that it's also become one of our key concepts as we talk about cash. Now, in addition to the value of cash itself, there's also some really important information in the statement of cash flows that is useful for decision making. Now, some of it is just providing that cash is king information, but some of it comes from the way we structure our statement of cash flows. Now, part of this information is risk information. How risky is the company? Are we able to make our debt payments? Do we have enough cash coming in to handle short-term obligations? There's some risk ratios and some risk information in cash flow information that's important for us to be aware of. But there's also some information in our statement of cash flows that we don't find anywhere else. I mean, you can find risk information in the balance sheet and income statement, but what you can't find there and can find in the statement of cash flows is an indication of where a company is in the product life cycle or the firm life cycle. From earlier classes, you probably remember that we can graph the life cycle of a firm or a product, something like this. And so we have up till, about here, we have an intro or startup phase. And then we have a growth phase. And then we have what we call maturity. And finally, we have what we call decline. If you're inside the company, you can see what's going on because you can see the product mix and understand how the company is doing and where it's getting its financing and looking at sales projections, etc. From outside the company, it's hard to tell where a product really is or where the company is within this life cycle from the basic financial statements, income statement, balance sheet, statement of retained earnings. But you can see it on the statement of cash flow. You see, in the introductory or startup phase, what we see is a negative cash flow from operations, a negative cash flow from investing as the company grows, and then we see enough cash flow from financing to cover the basic operations of the business and some basic growth. And that's the pattern of a company that's in the startup phase. As we move to the growth phase, cash flow from operations becomes very small negative or starts to go into a small positive, and it slowly builds more and more positive. At the same time, we still have negative numbers from cash flow from investing activities because we're growing the business, and those numbers start to get bigger and bigger and bigger as we continue to grow. And then cash flow from financing gets bigger to offset those negative cash flows for growth and to make sure that we have enough money to keep up our cycle. So providing us with enough working capital. As we move into the maturity phase, all of a sudden things flip. Now, instead of having a negative or small cash flow from operations, we have a huge positive cash flow from operations. Money's just kind of pouring in. We call a company or product that's in this phase a cash cow, and we see it in that huge positive cash flow from operations. What we then see is still a negative cash flow from investing, but it has tapered off. We are maintaining, not really growing anymore. We're just paying out enough cash to keep the business going, not anything extra to try to get bigger. And finally, for the first time, cash flow from financing switches from positive to negative, because now that I'm in a mature phase and I've got tons of money coming in, I start to pay off all that debt that I took out in startup and growth. I start to pay off my investors that have borne with me and been patient. I start to pay them dividends. I buy back my stock as treasury stock. I retire some shares, etc. Because now that I have enough cash, I don't need as many investors, but also I need to give them a return so they don't get upset. The final cycle of the firm is what we call decline. In the decline phase, once again, we see a shift in the statement of cash flow. Our cash flow from operations starts to shrink again. It may stay positive, but it starts to get closer to zero or into the negatives as the company declines, especially as we get towards the far end of that decline phase. We see cash flow from financing go either way. It can be positive if my investors are trying to save me. It can be negative if they're trying to get me to liquidate. But the big indication that a company is in decline phase is the fact that cash flow from investing starts to be positive. In order to try to save the business, I start to sell off my assets to generate cash. I'm trying to streamline and get rid of things that are distracting me from my core competency. And so for the first time, I see a consistent pattern of cash flow from investing being positive. Now, is this always the case? No, not really. Different companies are going to have different experiences with their cash cycles and in the way their firm and their product develops through the life cycle of the firm. But overall, we see these really cool trends that give us good indications of where a company is before we try to invest or decide whether or not we want to create a synergistic relationship with this company. So it's really cool that our cash flow provides us with information about the life cycle. It's the only place we really see that in our financial statements. In addition to providing information about cash, providing information about risk, providing information about where we are in the life cycle of the firm, the statement of cash flow also summarizes all of the major transactions of our business. It's all in there because we have to summarize that information and show it as part of determining cash flow from operating, investing, and financing. So debt that we've taken out, investments that we've made, repurchases that we've encouraged in our own business or with other businesses, what we're doing in our operating section gives an indication of pensions and leases, etc. So all of these fun topics that we've been discussing in intermediate accounting are all summarized in the statement of cash flows as it provides information and summarizes for our investors the major parts of our business. Really neat information in the statement of cash flows that you just don't find anywhere else. And that's why what we're about to talk about in these next few sections is so important. When we come back, we'll start talking in more detail about the statement of cash flows and how it's created. And then we'll get into an example where you actually get to build one. We'll see you then.